In 2008, the global financial system lost $30 trillion in 6 months. Not stolen, not misplaced, erased. 8 million Americans lost their jobs, 10 million lost their homes. Retirement accounts built over decades were cut in half, in weeks. And the people who caused it? They got bonuses. Goldman Sachs paid out $4.8 billion in bonuses in 2008. The same year they received a government bailout. The same year their own traders were internally calling the products they were selling to clients a piece of junk. That's not a metaphor. That's a quote from their internal emails, submitted to Congress. Under oath, nobody went to prison. One person received a federal conviction related to the entire crisis. One. And here's why you're watching this right now. Every single condition that existed in 2007. The debt levels, the unregulated financial instruments, the institutional conflicts of interest, the regulatory blind spots, exist today. Not similar conditions. The same conditions. Larger scale. Less oversight. This isn't history. This is a blueprint being reused. Let's start with the weapon. It was called CDO, a collateralized debt obligation. In simple terms, take thousands of individual mortgages, good ones, bad ones, ones that should never have been approved, bundle them together into a single financial product, slice that product into layers and sell each layer to investors as a rated security. The bottom layers were high risk, high return. The top layers were supposedly safe, AA rated, as safe as US government bonds. That AAA rating was the key to everything. Because pension funds, insurance companies, and municipal governments are legally required to hold only the safest assets. AAA rating meant they could buy these products, and they did, by the trillions. Here's what they weren't told. The mortgages inside those CDOs were increasingly made to borrowers who had no income verification, no down payment, and in many cases, no understanding of what they were signing. The industry had a name for these: ninja loans. No income, no job, no assets. Banks were approving them by the millions, not because they believed borrowers would repay, but because the moment the mortgage was signed, it was bundled, packaged, rated, and sold. The bank collected its fee and moved on. The risk didn't disappear. It was transferred to pension funds, to insurance companies, to municipalities, to anyone who trusted a AAA rating. And the rating agencies, Moody's, Standard, and Poor's, Fitch, were being paid by the same banks whose products they were rating. Not a conflict of interest, a business model. Between 2000 and 2007, the volume of CDOs issued globally grew from $69 billion to $521 billion per year. Every year. Larger, more complex. Meet one borrower, 2006 Florida strawberry picker, annual income $14,000, approved for a $720,000 mortgage, no questions asked. His broker received thousands of dollars in commission the day the loan closed. The broker's job ended there. What happened to the borrower was someone else's problem, more disconnected from the underlying reality of whether actual human beings could actually repay actual loans. This is the part that changes everything. Because the narrative, the one taught in business schools, repeated in documentaries, accepted by regulators, is that this was a systemic failure, a collective blind spot. Nobody saw it coming. That narrative is false. He kept selling them. Think about what that means. He knew the product was going to collapse. He wrote it in an email, and the next morning, he came back to his desk and kept selling it to pension funds, to teachers' retirement accounts, to municipal governments managing public money. In 2006, analysts at Deutsche Bank's own structured products desk calculated internally that the mortgage market was heading toward catastrophic failure. They used this analysis to place bets against the very products their colleagues were selling to clients. Morgan Stanley, Citigroup, Merrill Lynch, all had internal risk reports flagging the fragility of their CDO exposure, while their sales desk continued expanding that exposure. And then there were the people who weren't inside the banks, Michael Burry, a fund manager with no Wall Street connections, analyzed individual mortgage data in 2005 and concluded the entire subprime market was built on fraud. He spent 2 years trying to convince banks to let him bet against it. They laughed at him. Then they took his money, and because they were certain he was wrong, he made $700 million when the market collapsed. Steve Eisman, a portfolio manager at Front Point Partners, traveled to Florida in 2007 to interview mortgage brokers directly. What he found, brokers were coaching borrowers to falsify applications. Income was being invented. Properties were being flipped between related parties to inflate valuations artificially. He went back to New York and immediately restructured his entire portfolio to profit from the collapse. The information was available. The pattern was visible, the fraud was documentable. The question was never, did anyone know? The question is, did anyone warn you? Your bank, your pension manager, your financial advisor? Or did they keep that information inside the building and keep your money inside the machine? September 2008. Lehman Brothers files for bankruptcy. $639 billion in assets. Gone overnight. The U.S. government responds with TARP, the Troubled Asset Relief Program, $700 billion authorized by Congress to stabilize the financial system. Here is how the public conversation went. The government is saving the economy. Painful, but necessary. The alternative is worse. Here is how the math actually worked. The banks that received bailout funds had 2 categories of losses. First category, losses on assets they held directly. Mortgage-backed securities, CDOs, leveraged loans. These were real losses on their own balance sheets. Second category, obligations to counterparties, other financial institutions, insurance companies, and one entity in particular, AIG, on the world's largest insurance company, had sold a product called a credit default swap. Essentially, insurance against CDO failure. Banks bought trillions of dollars worth of this insurance from AIG. When the CDOs failed, AIG owed the banks. AIG didn't have the money, so the U.S. government bailed out AIG to the tune of $182 billion. And AIG immediately paid its counterparties. Goldman Sachs received $12.9 billion. Societe Generale received $11.9 billion. Deutsche Bank received $11.8 billion. Full payment, 100 cents on the dollar, no haircut, no negotiation, no requirement to share in the losses they had helped create. The Treasury Secretary overseeing this process was Henry Paulson, former CEO of Goldman Sachs. He recused himself from specific Goldman-related decisions. Goldman still received $12.9 billion. This is not a conspiracy theory. These are public figures, documented in congressional testimony, Federal Reserve records, and the TARP Inspector General's reports, all publicly available. The structure of the bailout was not designed to punish the institutions that created the crisis. It was designed to ensure their survival and their profitability at public expense. Here's where history stops being history. In the years before 2008, 4 conditions existed simultaneously. Together, they created the collapse. Warning sign 1, debt at levels that cannot be serviced. In 2007, total U.S. household debt reached $13.8 trillion, nearly equal to the entire GDP. Mortgages, credit cards, auto loans, borrowed against the assumption that asset prices would keep rising. Today, total U.S. household debt stands at $17.5 trillion. U.S. corporate debt has doubled since 2008. U.S. government debt has gone from $10 trillion to $34 trillion. The denominator changed, the ratio didn't improve. Warning sign 2, financial products that obscure risk. In 2007, CDOs were so complex that the banks selling them couldn't model their behavior under stress. Risk was invisible by design. Today, the derivatives market, financial contracts whose value is derived from underlying assets, is estimated at between $600 trillion and $1 quadrillion globally. The entire global GDP is approximately $105 trillion. The derivatives market is between 6 and 10 times the size of the entire world economy. Most of it is traded over the counter, meaning outside regulated exchanges with no central clearing, no public price discovery. Warning sign 3. Rating agencies with structural conflicts of interest. In 2007, Moody's and S&P were rating mortgage products AAA while being paid by the issuers of those products. Today, the same three agencies, Moody's, S&P, Fitch, still operate under the same issuer pays model. No structural reform was implemented. The conflict of interest that enabled the 2008 crisis is still the foundational business model of the credit rating industry. Warning sign 4. Regulatory gaps around the fastest growing asset classes. In 2007, credit default swaps, the insurance products that brought down AIG, were completely unregulated. No capital requirements, no exchange trading, no transparency. Today, private credit, loans made by non-bank lenders outside the regulated banking system, has grown from $500 billion in 2012 to over $1.7 trillion. It operates with minimal regulatory oversight. Valuations are self-reported. Liquidity is untested under stress conditions. 4 warning signs, all 4 present, all 4 larger than 2007. But here's the detail that separates 2026 from 2007. In 2007, the people who knew were mostly inside the banks. Today, the warning signs are public, published by the IMF, by the BIS, by the Federal Reserve's own stress test disclosures. The information is not hidden, it's just ignored. And that's a different kind of dangerous. In 2010, Congress passed the Dodd-Frank Act, the most comprehensive financial reform legislation since the 1930s. It introduced stress tests for banks, it created the Consumer Financial Protection Bureau, it required some derivatives to be centrally cleared. In 2018, significant portions of Dodd-Frank were rolled back, specifically the provisions applying to mid-sized banks. The threshold for enhanced oversight was raised from $50 billion in assets to $250 billion. Silicon Valley Bank had $209 billion in assets when it collapsed in March 2023. It was no longer subject to the oversight that might have caught the problem earlier. The pattern is not complicated. Crisis happens, regulations are passed, regulations are quietly dismantled, conditions rebuild, crisis happens again. Each time, the institutions with the most sophisticated legal and lobbying infrastructure absorb the least damage. Each time, the losses are distributed to people who had no part in creating them. This isn't a flaw in the system. It is the system. The only variable is timing, and the people who study these cycles for a living, not to prevent them but to position around them, are already positioned. The question isn't whether this breaks again. The question is when it does. Which side of the trade are you on? Drop your answer below. Do you think the next crisis is already in motion? Or do you think the system has actually been fixed this time? Because I think most of you already know the answer, and I think it scares you. It should.